All right, so yesterday Arthur Hayes gave us another fantastic Medium article, and in this article, he actually names it max bidding. So you can see where his sentiment lies, what he is thinking is coming. And in this entire article, he kind of gives his breakdown of why he is max bidding, why he thinks the environment is going to shift. And he makes some really good points. I'm not going to go over the entire article. I'm going to try to summarize some of what I feel the key points are, because I do think it's important. And this is going to be more of a macro outlook. So this is like macro, and then he narrows it down to how it'll affect crypto itself. So this whole thing is basically centered around the Federal Reserve pivoting, okay, which means that the Federal Reserve is going to have to start decreasing rates again, stopping its quantitative tightening, and go back to QE or quantitative easing and printing more money, which, when that happens, increases the value of hard assets. So hard assets include things like houses, gold, and he is including crypto in that. So I think crypto does belong in this, because if you look back at the COVID crash, when we came out of the COVID crash and things skyrocketed, that was when stimulus was being issued and a lot of money was being printed, and all of that led to an increase in token prices. So I think that you could consider crypto, especially like Ethereum and Bitcoin, hard assets. He lays out 4 scenarios, okay? So these 4 scenarios are what he is planning for and looking for in the future. So I'm going to read through these scenarios and kind of explain a little bit about what he is, like what the projection from this scenario would be. So scenario 1, Fed pivots and there's a successful Ethereum merge. This is like, you know, A+ for bulls. So if both these things happen, that is the ultimate bull case, because if the Fed pivots, there's going to be more money being printed. You know, it's cheaper to borrow money, and the Ethereum merge went through. This is great. Scenario 2, no Fed pivot, but successful Ethereum merge. Okay, I think this is still bullish for crypto, but it would be a lot less bullish, certainly. If the Fed doesn't pivot, I think that you might get a little pump in the Ethereum price at the merge, but I think after that it's going to be pretty much a non-event, because without the Fed pivoting, I mean, that's really the sole driver right now. No Fed pivot, unsuccessful Ethereum merge. So this is ultimate bear case, right? You know, the Fed doesn't pivot, the Ethereum merge doesn't go through. We probably head down from there, or at least just sideways in doing what we're doing right now. So that would, you know, that again, that's sort of ultimate bear case. Scenario 4, Fed pivots, but unsuccessful Ethereum merge. So I think in this case, what you would see is if the Fed pivots, that's like that's the most bullish thing that we could see as far as the hard asset category goes. So if the Fed does pivot, money becomes cheaper, we start printing again. I think that crypto prices start to go up from there. Now, if the merge is unsuccessful, that's certainly going to offer a short-term bearish, you might see a dip from the merge, you know, that kind of thing. But I think ultimately people would get over it, and that it would ultimately be bullish if the Fed pivots. I think the Fed pivoting is one of the most focal things that it's important for us to keep an eye on. And the reason why there's such emphasis on the Fed pivoting is explained further in this article. So Arthur goes on to explain how the U.S. economy is centered around monthly payments. We basically finance everything in the United States, from our home to our car to groceries to gas at the pump. I mean, everywhere you look, there's a buy now, pay later sign. And all of our, like, just about everything is financed in the U.S. economy. So what that does is it puts focus on monthly payments. No longer do people really look at how much they're borrowing in dollar terms, but rather, can they afford the monthly payment? And it's the shift, whether it's certainly a bad thing. I would not call that a good thing. This gives the Fed complete control over people's monthly budgets via interest rates. So if rates are going up, all of those monthly payments go up on the things like cars, rent, mortgages, all that kind of stuff. So with rates going higher, that becomes more expensive, and it squeezes personal balance sheets, which kills demand. Okay, and what we're seeing is a rapid deceleration in demand at the moment for things like cars and houses. I mean, Arthur puts up 2 charts in this article, which I'll put up on the screen, that show these exact things. We're seeing housing sales come way down. Car sales are also coming down. And this is all due to the constraints put on by higher interest rates. So what we're kind of seeing here is that with a financed economy, it's very... I'm going to get into what the A1 goal for the Federal Reserve is, because they're talking about it being inflation, but it is and always will be assets going up, okay? That is, whether they tell you it or not, the A1 goal of the Federal Reserve. Why is asset going up so important? Well, when you're in such a highly leveraged economy like you have with the United States, when everyone is borrowing against things, the bank is taking on risk, which is the loan it's giving to you, so it's counting on the collateral holding or gaining value. So if you buy something like a car, which is typically a depreciating asset, and we're in this car bubble that I firmly believe we are in, that you see at the moment, if all the car prices started tanking tomorrow, well, what would end up happening is that people would probably start to default on their payments because demand is so low. That probably leads to lower wage growth, people losing jobs, things like that. If you end up with all of that, then people aren't making their payments on their super expensive cars, and so the bank is now having to repo those cars, but it's going to take a loss on almost all of them if we start to see the car market tank. So same thing in housing. If housing prices start to tank, all of a sudden the loans that the bank gave are now underwater. And so the people, if they can't afford their mortgage and the bank has to foreclose, they can no longer recoup and make themselves whole. So this is a big problem in an economy like we see in the United States, right? So it can't work that way. We are quite literally, the dollar is quite literally a fractional reserve stable coin, okay? So picture something like anything in the crypto space, these algorithmic stable coins. Now, granted, the function is a little bit different, but picture a partially backed stable coin, okay? If the collateral behind the stable coin starts to go down in value on something that's already partially backed, that creates a huge problem, just like we saw in the crypto lending space. These lenders who were lending crypto to other people, taking on, Bitcoin as collateral or whatever it was. When Bitcoin goes down in value or Ethereum goes down in value, that collateral is now worth less. So if the business has to repo that asset, whatever it is, they're no longer able to recoup as much as they would have been. And so again, the whole thing doesn't work this way. Depositors lose in that case because they can't withdraw their money because there's quite literally not enough money to give them. Now, when you're talking about banks in the Federal Reserve, it's a little bit different because the Federal Reserve has the money printer. So if we start to see asset prices tank like this and come down super aggressively and people start withdrawing and banks get crunched on liquidity, the Federal Reserve can turn the printer on, give the banks more cash to lend out, which is what Arthur Hayes is basically counting on, is that he doesn't know if we're going to get to the point of asset depreciation, but what we might start to see is demand is already cooling. That is very obvious. And so if collateral starts coming down like this, the Federal Reserve seems to be projecting that they think that they've kind of done their job now. And they mentioned Arthur mentions in this article that they feel like they're at a point of neutral almost already, which is surprising to a lot of people. So neutral is basically when they feel like they've lined up supply and demand and curbed inflation. And right now, the Fed Reserve rate, with where it stands, it's still way below the inflation levels. So a lot of people were surprised that they would come out and say that they believe that they're close to hitting neutral or they've already hit neutral, which this is them opening the door to a pivot. I firmly believe that this is them opening a door to a pivot, and Arthur says that in this article as well, is that they seem to be opening that door, that they're getting spooked almost a little bit already by what we're seeing in asset price depreciation, and again, that can't sustain for very long. So as soon as we start to see things on the growth side take a massive downturn like we are, the Fed might be forced to pivot. Now, what Arthur is calling for and what he thinks is going to happen is that in September, we're still going to see a Federal Reserve rate hike. We might see 50 to 75 basis points. So if we see that, that's kind of already priced in and accounted for. But then in the December meeting, he expects that they're going to have to turn the money printer back on and pivot because he thinks that a lot of the rate hikes are going to take a strong foothold. We're going to be past the election piece, so keep in mind that midterms are coming this November. So, it's important that to politicians that we are not in a recession at that time, because that has a big effect on voters. So there's a lot of stuff lining up right now that could lead to a Fed pivot. And when the Fed pivots, again, they have to turn the money printer on, which in turn means hard assets typically appreciate in value. And I think that this is a very real case that could be made here. And I think that the market itself, the legacy markets, so the stock market, and the bond market, they're already sort of projecting this. They're already sort of pricing in a pivot come the end of this year. Now, it might be a little bit ambitious in some cases. I know a lot of economists talk about how a pivot by the end of the year is maybe a little too aggressive. However, I think a lot of people were thrown off and shocked by the Federal Reserve's talking about and leaving the door open for the pivot. So again, all stuff we want to keep an eye on. I think that Arthur did a really good job at summing this up in the article. So if you guys want to read it, I highly recommend you do. I'm going to link it down below. But ultimately, that's what we're keeping an eye on in the crypto space currently. And the way the whole world works right now, again, A1 priority for the Federal Reserve is asset prices go up. And again, he's talking about the United States in this case, but a lot of the world's currencies and other countries all work very similar to this, okay? When asset prices really come down and the cost of money goes up, that's a bad combo, and so it can leave people really strained and not able to afford their debts. And if they can't afford their debts, then the economy itself quite literally crumbles. So keeping an eye on that. I'll continue to follow this, guys, but I wanted to share this awesome Arthur Hayes article with you guys. If you found this video useful and this is your first time to my channel, please hit that like and subscribe button. I'd love to have you guys along for the journey. With that being said, I'll see you next time.